Hello everyone, today with MarketXLS we're going to talk about the bear put spread option strategy. MarketXLS is one of the top Excel-based investment research solutions for investors. It makes it easier for you to turn your Excel skills and market knowledge into profit. In this video we'll be discussing what a bear put spread strategy is, how it works, and how it is calculated using MarketXLS. So without any further ado, let's start with the topic. A bear put spread is best implemented when you expect the underlying security to go down moderately in the near term. A bear put spread strategy is a limited profit and a limited risk strategy. So what we do in this strategy is that we go long on one in the money put option and go short on one out of the money put option of the same underlying security and expiration date. MarketXLS offers a template for this strategy. Here's an introduction page for the users to read, and here's the active template. The yellow cells have to be inputted by the user, so the stock ticker, expiry date, in the money strike price, and the spread. Some upcoming expiry dates are available for reference on the side, and for the purpose of this video, we'll be using Microsoft expiry date as 11 June. In the money strike price for put is $255, and with ball 1 in the money $255 put option and sold 1 out of the money $250 put option contract of Microsoft. In this case, we've built the net debit strategy and paid $250 to enter into the trade, which is reflected in the net cash flow section. MarketXLS has many templates just like the bear put one you see here, and it refreshes all the data when you click on Refresh All. A payoff schedule and a payoff diagram are available in the template too. They can be used to analyze the maximum gain, loss, and break even. Maximum gain for the bear put spread is limited and is achieved when the stock closes below the strike price of the short put on the expiration date. This is shown by the green box. Both options expire in the money, but the higher strike put that was purchased will have a higher intrinsic value than the lower strike put that was sold. Therefore, maximum profit for the bear put spread option strategy is equal to the difference in strike price of puts minus the debit taken when the position was entered. Maximum loss is limited to the extent of net debit taken to enter into the trade. Maximum loss occurs when the stock price rises above long put option strike price at the expiration date, and this is shown by the red box. Break-even point can be calculated by using the formula strike price of long put minus the net premium paid. That is all for today. If you want to read more about this topic, please visit the MarketXLS website, which has hundreds of blogs and templates. If you want to get in contact with us, please book a demo and we'll be happy to help.